Hello, everyone, and welcome back to the world's best investing podcast. Turmoil continues in the market. Duolingo is down 5%. There's a lot of people crying. There's a lot of people concerned. Engagement is down on social media. What is really happening? I'll tell you what's happening. Retail investors did very well from April. All the masters of the universe sold in April, saying it was the end of the world. They were on CNBC saying that was it. It was the end. It was the end of the US. Ray Dalio was saying he was finally thinking about moving to China. No, I'm kidding, but literally, right? And so a lot of retail investors bought in April. That's led to a tremendous outperformance, and that was simply too much for the average retail investor because now people gradually started buying the narrative that this is a bubble. And you had what Tom Lee calls backhanded compliments from institutional, which still have a large weight on retail psyche. So they were saying, yeah, it's the market is very hot, it's going to do very well, but it's 1999, and the thing has permeated the minds of retail investors. And so now you've seen retail investors selling Duolingo, selling hymns, and institutional ownership has gone up. I posted it on my X, and this has been too much. This goes back to what I was saying. I think it was a few months ago. We're going to see too much winning. It's literally going to be too much. And it just shows you that still the vast majority of retail investors are not able to understand the connection between fundamentals and price action. Really, what are you holding? What are you owning it? What's the purpose of owning a stock? What is a stock? Is it a company? What are the fundamentals of the company? A lot of retail investors just don't look at that. The reaction of the past week has been quite emotional. I know there's a lot of you which are actually money makers, and you keep your psyche steady because you're winners. But I think that we're just seeing a lot of is too much winning. It's when humankind wins too much, they get self-destructive. Now, this is just this is a classic market mechanism. When valuations go up a little bit too much, maybe then the market has this self-correcting mechanism. So this is price action. It's designed to, this is how the market weighs companies over the long term. At the moment, however, investors voted that this is too much. Now, the question is, where is this headed? Because when you have this kind of price action, it would actually make sense to sell maybe if you think that things are not going to be much better in the future. Whenever you buy a tech stock, you just have no idea what the income statement is going to look like a few years from the present time. And so that is why discounted cash flow models are fundamentally useless. You have no idea. If you guys think a discounted cash flow model is useful, try and reverse engineer one that would have told you how successful Palantir and Spotify have turned out to be. It just doesn't work that way. So you always want to be holding pieces of tech companies that you believe are going to do exponentially better. And obviously the trend that's pushing everything forward, including the broader economy, because the rest of the economy is pretty much in shambles right now, and inflation has destroyed the purchasing power of the average individual in the West, is AI is pushing this forward. What is the state of AI? Is there a causal chain between AI CapEx and incremental value delivered? And that's why you have to dig into earnings reports. Look at Amazon's earnings report. Look at Meta's. Look at Microsoft's. And just say, understand the nature of this underlying fundamental driver. Is it going to take us to a better place or not? Look at this. I told you guys in my Amazon video last week how people shopping with Amazon Rufus, so their AI shopping assistant, are 60% more likely to buy. Okay. Now, if you look at Meta's numbers, they're actually pretty similar. It's a different business, but directionally the same. So time spent on Facebook and Threads is up 5% and 10% respectively quarter over quarter. Time spent on both apps is up, quote unquote, double digits year over year. Time spent watching videos on Instagram is up 30% year over year. Lattice, which is the model Meta uses to drive ad conversions, yielded 3% incremental conversions for ads quarter over quarter. If you look at the graph on the screen now, you can see that as Meta deploys more CapEx, free cash flow per share is going up. What this tells you basically is they put more cash into the business, they print more cash, they get more cash out. Free cash flow per share is obviously affected by CapEx. So if you increase CapEx, it's going to tick down a little bit. But here, what we see in the last quarter is really just a continuation of the trend. And just to be very blunt, okay, I don't only think that this is a self-destructive moment for retail investors. I also think that I'm long Mark Zuckerberg's capital allocation framework, and I'm short the emotional reaction of retail investors. By the way, I don't think it's institutionals. I mean, if you just look at the institutional ownership of these companies, they are going up. They've been going up for the past 2 months as retail investors have been getting emotional. I hate to see that because I'm team retail. Okay. But here's a quote from Mark Zuckerberg, which I think summarizes this very well. Just to give you some context, I've been saying for months now how this is yielding a scenario which is escaping the ability to reason of the average human. So we have AI capabilities doubling every 2 months, and value creation processes of the good companies are evolving in tandem, and that's just faster than it's surpassing the ability of the average human to reason. And so the default is the knee-jerk reaction. So these guys go on CNBC, they say there's a bubble, and retail investors get emotional. It's more important now than ever to be focused on fundamentals, because actually I think that the opportunity ahead continues to be as vast or even bigger than I've been saying. And as I was saying, I'm long Mark Zuckerberg's framework. I'm probably not long yours. Again, likability points, no respect if you get emotional during market turmoil like this. A lot of people keep saying, well, where's the proof for your work? The proof is here. Everyone is getting emotional. I'm standing up for my convictions. I literally do not care that Duolingo declined. I'm buying more. I bought more in my pocket money account. Today, I'm doubling my position in the big account. And the proof is in not getting emotional and fundamentals. So just listen to this guy, listen to what he said, and just try to process this. He said, but to date, we keep on seeing this pattern where we build some amount of infrastructure to what we think is an aggressive assumption. And then he said, and then we keep on having more demand to be able to use more compute. So basically what Zuckerberg is saying is this thing just keeps defying their linear assumptions. And their linear assumptions seem too much to outside observers, which is why Meta was down 18% last week as part of the emotional broad-based reaction. And then these guys, they actually just increased their CapEx. So they were saying that CapEx is going to go up from a given range, which they clarified. Yeah, so they said 66 billion to 72 billion for fiscal year 2025. And now they said 70 billion to 72. Is that a good reason to sell Meta stock, bring the price down 18%? Again, like with Palantir's valuation, you could argue the fair valuation is 70% less. But if you have a value creation process that's basically doubling its speed every 6 months, the valuation is going to come and bite you back in the ass at the moment. I don't think this company is unreasonably valued. I do understand Palantir is up for debate, but generally what I see is retail has lost the connection to fundamentals here. And that is because the narratives from institutional investors do have a way do have an impact on the collective psyche. What happened is these guys sold at the bottom in April. And now simultaneously, it always happens that when someone shares a bullish thesis, that person is by default an idiot. You just look like an idiot. And it's something that I know. When I say something has 100x potential, I'm literally saying to myself, I look like such an idiot, right? But and then talking about humility, I've had a lot of people talking about humility. I'm getting a call now. Should I get this call? No, screw it. Humility, what is it? Well, the current definition of humility in the West is not winning. And we're not winning. A lot of us are not. I mean, I am winning, and I know many of you are winning, but at the moment, that is humility. It's basically shutting up, not using your talents, and just sticking to whatever the agenda is, right? Humility actually is embodying truth. And so if you think about my calls over the past few years, when I said, Spotify was the Google of audio in the making when it was trading at $97, I said Spotify had no competition, was a multi-trillion-dollar company in the making at $7. Said something very similar about HIMS at 15. True, their full potential hasn't been fulfilled just yet, but actual humility would be saying, look, I thought your calls were clickbait. I was wrong. Here's what I learned. No one is saying that. I'm absolutely happy owning up to my mistakes. And I believe that is actually true humility. It's not relatable because it's an attitude that trying to win and claiming your wins and then owning up to your mistakes very quickly and learning from them very quickly and recovering your confidence to go and attempt new wins is actually not a common thing. I do understand it comes across as arrogance many times, but it's not. I just like to play this game with intensity. And whenever I've made a mistake, I've recognized it. Anyway, Meta's CapEx is going up a little bit. Is that a reason to sell it? I don't think so, because Zuckerberg is the best. He's probably the best AI capital allocator worldwide. And so I'm actually long his train of thought, probably not yours. Here's something else he said, which I thought was very insightful. He said, and like I said in response to the last question, we are sort of perennially operating the family of apps and ads business in a compute-starved state at this point, which is, on the one hand, sort of an odd thing to say, given the compute that we built up. everything is looking, to me, the logic. Firstly, earnings are pretty strong and metrics are coming in very well. And so this accelerated value creation process has created this scenario that I'm capitalizing on. I just think intellectually it's also interesting, but it also comes down to a question of values. Do you think that because a stock goes up very much in the short term, is that too much winning for you? Is that too arrogant? Maybe it doesn't get you friends. Maybe you want to be relatable and that's why you sell. I'm not saying you should buy or sell anything. I'm saying what we have here is a sort of psyop, potentially not intentional, but it's something that happens in the markets a lot. You just have people thinking it's too much success for them. And I warned you guys. I said months ago, there's going to be too much winning. It's potentially going to be too much. And here you go. There's no logic to anything, to any of the counter arguments to anything that I'm saying. There is no logic. So if I say Palantir can get a lot bigger, there is no counter argument to why is this company's value creation process accelerating, doubling every 6 months? Why is it doing so at a marginal cost? Why is time spent on family of apps going up? Why is Meta printing more free cash flow per share as they deploy more capital? There is no conversation. It's a one-sided conversation whenever I share my investment ideas. And that is because, as Alex Karp was saying on his last interview, analysts are using a framework which is 50 years old, and it doesn't actually enable people to understand the current value creation processes and how to analyze them. So it's happened many times. Look, like in April, it was understandable. It was actually harder than now because what you had was a macro situation which you don't control. Still, the mantra is the same. If you bet on extraordinary companies, these companies are actually more likely than not to emerge fortified from bad macro. Here, it's the same. Mark Zuckerberg was saying this during the call. Worst case scenario, if they build too much, it just takes them some time to grow into the infrastructure. The best analogy we have for this period of time is the railroad build out. So there were actually countless booms and busts for the railroad thing in the US. And the thing is, it obviously happened in a slow motion because this was the physical economy, still not as great engineering as we have now. So the build out arguably took decades and decades. What we are going to see here is that in a compressed time period. Maybe now you see a correction, which is like 70%. We saw it in 2022 and 2021 was literally nothing. The point is, you can't let price action dictate your emotions. You have to understand what you own, what you're invested in, how these things are creating value. And so we saw many booms and busts with the train. And still, the US built out this infrastructure. The infrastructure continues to pay dividends to this day. So there's companies that were actually founded in the mid 19th century and they IPO'd like 6 decades ago or something. They're up like 1 billion fold from the IPO, and that's not even accounting since the foundation in, say, 1850. That is what you're looking at with AI now. And so this conversation of quarterly ups and downs, one, is ridiculous. Two, it's myopic because the fundamentals are goddamn perfect. And so, conversely, on a positive note, I think there's a lot of winning coming. And I think that Duolingo is going to be, one, an extraordinary success. Two, I think Meta is going to be a very big success too. One of the first things I did when I jumped on the internet I did so beforehand, but I wrote a deep dive on Meta in 2022 after the stock went down 70%. And I said, this thing is a massively asymmetric investment opportunity. So the market actually thought that Mark Zuckerberg was betting the ranch on the metaverse. CapEx was going up a lot. Actually, this guy was investing all that CapEx into AI data centers before the world was aware of the LLM revolution. And then since, what's happened is the family of apps has gotten impossibly addictive. Everyone thought TikTok was going to kill this company. Not true. Everyone thought this company was doing something very risky. Actually, not true. Is free cash flow per share up massively since? Yes, it is up massively. And actually, I can give you the exact metric. So in 2022, it went down to 7.1. Now it came in at 17.3, and that's down from 20.7 in last year, basically same quarter last year. So yes, up meaningfully. This is just the beginning. And the thing is, with the stock market, you need to have a long investment horizon. Otherwise, you get emotional and you sell. You should never be investing money that you think you're going to need in the next 5 years or even 10. These things are very long duration. But conversely, if you do invest something in a company, knowing that it's a long duration kind of asset, which it fundamentally is, these are not pieces of paper. These are actually slices of a company. then you can make tens, hundreds of times your money. If you look at, I was talking about the railroads and I made a tweet about this some months ago, but there's a company called, I'm not sure. Anyways, there's a bunch of these railroad stocks that are up big time over the past few decades. And I don't have the stock here, but I made the tweet. It's the emotional thing is what makes people not make money in the stock market. So if you look at Duolingo's fundamentals, there is just no way to argue that the company is not doing well. ChatGPT was released in November 2022. I shared a post, I think it was a few weeks ago, where you have the S&P 500 going up and then job openings going down. And the bifurcation started right after the release of ChatGPT. And so that factor has been there for Duolingo, and still free cash flow per share is exploding. And so this is a sort of retail driven, I would say, pseudo correction. It's nothing to be sad about, right? This is how we make money. But I think that it's a very good thing to do, to study these narratives and how they affect prices. And obviously Meta is up something like 450% since I wrote that deep dive. I know many of you actually decided to buy that. There's very cool stories about it. But in this game, you can't let price action dictate your emotions. If anything, by default. I mean, you have to have identified the list of companies you like, which you think are extraordinary, and then you need to lean into the pessimism. So when you least want to buy, that is the moment to buy. As I've said many times, lower prices are better than higher ones. But the thing is, when these things go on sale, people don't want them because it comes with a whole emotional package that I think is hard for investors to transcend. However, there's a lot of retail investors, as I know, that are still invested in these companies or whatever company they may think is good. And I think that the strategy, the correct one, by a long shot, is just betting on founder operators and doing so for a long time. There's key man risk in these companies for sure. Like, with Duolingo, the key man is Luis. With Tesla, it's Elon. With HIMS, it's Andrew, most likely, it would seem to me. And so long term, a portfolio of this sort, some of the key man risk is fairly likely to materialize. But then in my portfolio, I have just 6 stocks. So I actually think that at least one of them is going to play out to the degree which I think it's going to play out, i.e. 100x, 200x, something like that. Do I need that to happen in 3 years' time? No. Could it happen in 5 with AI value creation processes? I actually think that for Duolingo and HIMS, it's quite likely. Do I need that to do well? No. Could it happen in 10, 15 years? Yes. If it happens to just one company, because my portfolio is relatively evenly spread out between 6 picks, that's okay. And then so far, I've also made a lot of money with Palantir and Spotify. They've both returned my entire portfolio more than once. So obviously beating the market. And look, it's very simple to track my portfolio. I don't have like a private one and a public one and, one for charity and stuff like that. I have one goddamn portfolio, 6 stocks, holding each one for the long term. And 5 of them thus far have been massive multi-baggers, right? So look, it's not, when I succeed with this thing, I don't think I have like a high intelligence or whatever. I spend a lot of time looking at fundamentals, and I think the actual edge is behavioral. So understanding that when things go south emotionally, that doesn't mean that the actual companies are going south fundamentally. And so that's it for today. Meta shows that the AI revolution is real. It shows that it's just getting started because they can literally suck human attention dry over the next decade. It's not something that fundamentally could be good for humanity, I think, but they're still going to do it. We're still all going to be on these apps and stuff. And look, I think that a year from now, 2 or 3, many of the prices that we have today in the market are going to be extraordinary. Just like if you look back to any of the emotional moments in time, the same applies, because we are fundamentally long innovation. So anyways, guys, thank you very much for joining me. Have a good day. If you enjoyed this update, could you please share this with someone else? These videos and updates are for free, and so the only way this grows is with your help. So thank you very much in advance. Take care and see you next time.